IFRS 18, the new presentation standard, brings quite big changes in how your financial statements might look like, so let's sum it up and see what's new. This lecture has a few parts. First, we will introduce IFRS 18 in the short overview. Then we will look at the general requirements for the financial statements, especially what the complete set is. Next, we will focus on the statement of profit or loss, and here are the main changes in comparison with IAS 1. Then the statement of other comprehensive income, statement of financial position, statement of changes in equity, and finally the notes. I am Sylvia of cpdbox.com, and let me invite you to sign up for my free IFRS newsletter packed with free lectures, practical tips, and other materials on cpdbox.com. So, IFRS 18 was issued in 2024. It replaced the oldest standard IAS 1 presentation of financial statement, and the effective date is 1st January 2027, but you can apply it earlier. That is possible. Let me warn you that you should apply this standard retrospectively, so it means restatement of earlier periods. And so you should really be focusing also on the period of 2026 at latest. The objective of IFRS 18 is to set the requirements for presentation and disclosures in the financial statements for general purposes, just to help users provide relevant information about the reporting entity's assets, liabilities, equity, income, and expenses. This standard is quite extensive, quite significant, contains loads of guidance, and it is structured into a few parts. First, general requirements for financial statements, aggregation and disaggregation, and then the parts dedicated to individual statements like statement of profit or loss, statement of other comprehensive income, statement of financial position, statement of changes in equity, notes, and appendices with defined terms and additional guidance, which is, by the way, as mandatory to apply as the rules in the standard itself. So let's start with the general requirements. To fulfill the main objective of financial statements, a complete set of financial statements comprises of a few components. Statement or statements, let me explain this a bit later, of financial performance. Statement of financial position or balance sheet, statement of changes in equity, statement of cash flows, which is further described in IAS 7, and notes. Now, all of these components are prepared for the reporting period, telling us a story of what happened during the year or other time period that you're reporting. So they're like a video, well, except for one, which is prepared as at the end of the reporting period. So the statement of financial position is a snapshot, a photograph of what the entity has and owes at a certain point of time. Also, we have to state the comparative information and the third balance sheet if necessary under circumstances. When it comes to the statement or statements of financial performance, you have two options. Either present it as a single statement with two sections, one for profit or loss and one for other comprehensive income, or as two separate statements, one for profit or loss and one for the other comprehensive income, your choice. Each component of the financial statements must be clearly identified, so it must clearly say which statement or notes we are looking at. Here it's statement of comprehensive income. Then there must be a name of the reporting entity or information about its change, whether the financial statements are of an individual entity or a group of entities, the date of the end of the reporting period or the period covered by the financial statements, information about presentation currency and the level of rounding used in presentation of numbers. And then IFRS 18 provides a few more principles about the frequency of reporting, so how often you should present the financial statements, consistency, and comparative information. Now, a separate section is dedicated to aggregation and disaggregation, speaking about the principles of which items to group and which to break down, and about offsetting. So that's for the general part. Let's take a look to the rules for presenting the statement of profit or loss, where we see the biggest changes in comparison with older IAS 1 standard. So IFRS 18 introduces categories in which you need to classify all expenses and income. There are 5: operating, investing, financing, and those 3 might seem like from cash flow statement, but they are not the same thing. They are different. The last 2 categories are income taxes and discontinued operations. So before we speak about what goes where in general, there are exceptions. So for the first 3 categories, we need to assess whether the entity has specified main business activity. And that could either be investing in some type of assets, that would be, for example, investment fund, or providing financing to customers, for example, banks. Obviously, due to the character of their main business, these entities classify many of their expenses and income in operating rather than investing and financing category. For example, interest expenses are in financing category for production company, but in operating category for a bank. Now, let's dig into details. The first category is operating category, and this is default category. And it means that here are all the income and expenses that are not elsewhere, so not in financing or investing category. The second category is investing category. And here we need to present income and expenses from investments in associates, joint ventures, and unconsolidated subsidiaries, cash and cash equivalents, and other assets if they generate returns individually and largely independently of the other resources. For example, rentals collected from investment properties or interest from bonds that you hold. The exception is, of course, entities whose main business activity is investing in assets, as we mentioned, and they would present these items in operating category. The third category is financing category, which basically is all about income and expenses related to liabilities. So here we need to make a clear distinction. There are liabilities from raising finance, like loans payable, bonds payable, and similar. And in this case, income and expenses from initial and subsequent measurement of these liabilities, like interests, and also incremental expenses like transaction costs, are presented in financing category. The second type of liabilities are other liabilities not related to raising finance, for example, provisions or employee benefits. And here, interest income and expenses from changing grade, if they are both separately identified by the entity, are presented here. The exception is the entity with main business activity of providing finance, like banks. So here, those items from raising finance go in operating category. So categories are definitely the new thing in IFRS 18. You don't need to label them as such though. Then we have new subtotals required by the new standard. So we must first present subtotal for operating profit or loss. That is, in fact, all income and expenses in operating category. Then we have profit or loss before financing and income taxes, which is the previous subtotal, plus investing category income and expenses. And finally, profit or loss for the period. Again, this might look a bit different for entities with specified main business activity. IFRS 18 then prescribes certain line items to be presented on its face as a minimum. You can see the list here. It is not exhaustive. And let me remind you that entity must present profit or loss in allocation between owners of the parent and non-controlling interest. Let's move to the statement of comprehensive income. Here, we need to present certain totals for profit or loss, that is carried from the profit or loss statement. Then other comprehensive income, and here you need to present individual items in one of the 2 categories. Those that will be reclassified to profit or loss when conditions are met, and those that will not be reclassified. Which is which? Well, that depends on the rules of the specific standards. Finally, the total for comprehensive income, which is basically the sum of the profit or loss and other comprehensive income. Again, allocate the comprehensive income between owners of the parent and non-controlling interest. The statement of financial position or balance sheet. Here IFRS 18 did not change much compared to IAS 1. So here's the list of items that shall be as a minimum included in this statement. On the asset side, you should present property, plant and equipment, investment property, intangible assets, and other assets as listed here. And then usually under liabilities and equity, you need to show trade and other payables, provisions, financial liabilities, non-controlling interests, issued capital, and reserves attributable to the parent. Some items might have asset or liability character, so could be presented in both categories, such as totals of assets held for sale and totals of assets and liabilities separately in disposal groups according to IFRS 5. Groups of contracts under IFRS 17, those are insurance contracts. Those can be either liability or an asset. Liabilities and assets for current income tax according to IAS 12. Deferred income tax according to IAS 12. IAS 1 requires the line items to be presented separately in the current and non-current distinction. So current assets separated from non-current ones, and the same with liabilities. Statement of changes in equity carried over from IAS 1. So here the entity shall present at least total comprehensive income separately, amounts attributable to owners of the parent and to non-controlling interests for each component of equity separately. Effects of retrospective application or restatement are recognized according to IAS 8, and for each component of equity separately, reconciliation between the carrying amount at the beginning and at the end of the reporting period. And here we must disclose separately changes resulting from the profit or loss, other comprehensive income, and transactions with owners, such as contributions from owners, distribution of dividends, and similar. If you'd like to learn how to make the statement of changes in equity, you're very welcome to visit cpdbox.com. Finally, let's take a look at the notes. IFRS 18 makes changes here too, but let's see what should be stated here. First, information about the basis for preparation and accounting policies used, and then information required by another IFRS not presented in primary financial statements. So those are all subtotals and additional information required as disclosures in line with many standards like IFRS 16 for leases or IFRS 9 for financial instruments. Next, other important information not presented in primary financial statements. For example, about some events that might have affected the business. Here we need to present also general information about the entity, if not shown elsewhere, like description of its activity, legal name, who the parent is, etc. Management defined measures. I'll make a whole new video lecture on this one because this is new in IFRS 18. But these are simply numbers outside IFRS reporting used by the entity to communicate its performance. And here we must present what they are and their reconciliation to IFRS reporting free measure. It could be free cash flows, just as an example. Then capital-related disclosures as carried from IAS 1. Sure, you need to present notes in some systematic manner and do not forget to cross-reference them to the financial statements. So that's about it for this relatively short summary. For full IFRS lectures, let me invite you to sign up for IFRS Kit, and I bet you'll put your IFRS progress on a real fast track. Thank you for watching this video. Please share it. And if you're not subscribed, do this now so you won't miss any new lecture. Bye!